Welcome to Yahoo Finance's special coverage of the December CPI report. I'm Julie Hyman, and the numbers coming in mostly in line with estimates. In fact, a little milder on the core level. Consumer price index month over month rising 0.3%. That is in line with the average economist's estimate. But if you strip out volatile food and energy costs, you get a gain of 0.2%. That is versus the 0.3% that was estimated by economists. So again, the core inflation number on the consumer level coming in better than had been anticipated. If you look at the year-over-year numbers, you get exactly the same picture. On a year-over-year basis, rising 2.7%, and a core year-over-year basis rising 2.6%, which matches the prior month, and again is 0.1% better than had been estimated. And there were a lot of questions surrounding this report because of the government shutdown, because of the prior CPI report and the survey period, and some tweaks that some economists had questioned about how that report was put together and sort of how clean, quote unquote, the data was. So this report being seen as a better, more credible data, and sort of confirming that we are seeing a little bit of a slowdown in the inflationary picture here. I need to go through and look at the components, as I'm sure that our guests are going to be doing as well. But the shelter component going to be really important in here, because that was one of the more questionable or volatile elements within the last report here. And I'm seeing here that the index for shelter was up 0.4% in December. It was the largest factor, according to the Bureau of Labor Statistics, in all of the monthly items that they track. The food index was up 0.7%. That includes both food at home and food away from home. The index for energy up 0.3%. But again, you take out those food and energy costs when you look at the core number. Shelter, the biggest change and the biggest components there. So that's something to continue to keep an eye on here. And again, the core number up 2.6% on a year-over-year basis. As I take a quick glance at the markets here to see what kind of reaction we see there, futures trending a little bit lower, but they had been trending a little bit lower. Actually, it looks like they've turned around and are a little bit higher now. So we're going to keep on watching the futures here and to see what they indicate throughout the course of the morning. So we're going to keep an eye on that. And joining me now to break down the CPI report is Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director, Claudia Sahm, New Century Advisors Chief Economist and former Federal Reserve Board Economist, and George Bory, Allspring Global Investments Chief Investment Strategist for Fixed Income. Everybody, thanks so much for being here. Jennifer, let's start with you here. It looks like that this is a confirmation of the sort of disinflationary trend. Is that how you're reading these numbers?
Good morning, and thank you very much for having me on this esteemed panel. It looks like it's everything was basically in line with expectations, better for the core, as you mentioned. So this is good news in the sense that nothing is really, for this report as it stands, standing in the way for further rate cuts from the Federal Reserve. You know, when that's going to happen is another story. And of course, they are dealing with a whole lot of other hoopla going on right now as well. But in terms of for the economy, it shows that there is some more, easing price pressures. But I will point out that food, again, at a glance, looks like it was still up 0.7%, which is still fairly high. And this is what consumers are looking at, right? This is what you're seeing on a regular basis when you're pushing your cart around the grocery store, and these are all about groceries. So that's something that still needs to be worked on.
Claudia, I know you were paying a lot of attention to that shelter component, again, as I mentioned, because of the prior survey, some assumptions perhaps that the BLS had made. So the shelter going up 0.4% in December, what does that tell you?
Right. And I would add to that, the discussions about Fed officials like Stephen Myron, who are looking for a lot more disinflation this year, really focus on what's happening with shelter and the possibility that that really turns down. And I think looking at the data, even coming into this report in September, owner's equivalent rent was really mild in terms of a month over month reading. And today what we see is something closer to 0.3, which has been, a slower pace than we've seen in recent years, but not a dramatic drop off. So what I would say in looking at the monthly rates for owner's equivalent rent, for tenants rent, they're showing that we've had disinflation in the shelter component, but it's not that it's really driving kind of the inflation trend down.
And George, let's get your impressions here and what the implications are for the rates markets.
Yeah, well, as as my colleagues just mentioned, the disinflationary trend does look like it's in place. It may have hit a little bit of an air pocket at the end of last year, but it does look like this slow, steady kind of deceleration of price increases is unfolding. It's not evenly spread across the economy, and we know that there's still some noise in the data, but we don't need to be worried about accelerating inflation at this point. And so when you look at the bond market, we're seeing bond prices kind of pop up a little bit, not hugely, but it does sort of keep the window open, if you will, or the door open, whichever channel you want to get yourself through, for the Fed to continue with their easing bias. They don't. There's no urgency to move, although the president would like them to move a lot more quickly. But the data suggests that they can continue down this easing path. They can have a bias towards easing policy without the fear that inflation is going to run away from them anytime soon. And so we're seeing a little bit of a bid to the front end. The long end has come down a bit, but remains fairly elevated. As I think maybe it was Claudia just mentioned, obviously the Fed is facing a lot of challenges right now, and markets are still kind of asking themselves what to expect from the Fed longer term, and whether or not rates are going to come down substantially, and that accelerates inflation perhaps later in the year, the second half of this year, or maybe into next. But that's still, those are worries we can worry about, sort of 6 months out. So for now, pretty good for the bond market. It seems like stocks like it as well because it keeps the Fed in play. And this whole notion that easier monetary policy is coming at a slow pace, consistent with inflation, should help financial markets.
Well, I am curious if others on the panel see any coming upside risks to inflation at all. Claudia, I'll start with you on that. I mean, there's a lot of talk about the stimulus that's coming from the tax bill that's sort of going to be coming into the economy early this year. Any risks there that we could see upside pressure on inflation as a result of that?
Well, absolutely. I mean, that's a support to demand. It's been something of a puzzle that the extra costs that the tariffs have generated have really sat with U.S. businesses, and we haven't seen the pass through to consumers. Sometimes we see businesses talking about, price pressures on consumers are more sensitive. And if you have a moment where people are a little bit more flush with cash, then they're less sensitive. So it may be an opportunity for businesses to pass on more of those costs, or just costs in general in terms of higher prices. So it's something to watch. And I'm still skeptical that we've, seen all of the distortions to the data work their way through. I think the data fog of measurement is lifting gradually. So I'm not convinced this is an absolutely clean year-over-year read at this point. But, in terms of big accelerations, I don't see that in the forecast.
Gotcha. Jen, what about you? What are some of the upside risks that you're watching to inflation? Or conversely, do you think that things are going to come down more quickly than perhaps we're expecting?
So, full disclosure, at the beginning of the year, beginning of last year, I thought that we would be seeing a lot more inflationary pressures, just given, especially from the tariff front. But like Claudia just mentioned, it's amazing how businesses have been able to absorb or hold on to a lot of these gains. But, I don't think that's going to last forever. We've heard some rumblings from big corporations that, there are higher prices coming down the pipe. So we'll see how that goes. It certainly helps that we've seen a lot of these potential pressures coming from, from the government in terms of oil prices and housing, and of course on food prices like Italian pasta or Brazilian coffee or something like that. Electricity that we saw this morning, pressures on the tech sector. At the same time, other things that policies can't directly completely influence is like, climate issues as well, and all the wonky weather that we're seeing has played havoc on food prices. I'm going back to food again, because this is what consumers are seeing instantly or on a regular basis. We saw sky high prices of rice in Japan, record high oil prices, I believe, in Spain, as an example. Especially, and also on the demographic front, the fact that we're seeing, smaller labor supply because of all the deportation issues. At the same time, we're also seeing there's also the probability that U.S. population growth is going to start slowing even more meaningfully, and that could potentially put upward pressure on wages. But that's more of a longer term story. So I don't think we're completely out of the woods just yet.
And guys, we got to talk about the sort of elephant in the room here that you've all alluded to in various ways, and that is this criminal investigation into the Federal Reserve and the renovation of the Federal Reserve building. It's interesting because we're starting to get into bank earnings, and of course, someone right off the bat asked Jamie Dimon on the JPMorgan conference call about the Fed. And here's what he said. I do have enormous respect for Jay Powell. Everyone we know believes in Fed independence. Anything that chips away at that is probably not a great idea. And in addition to that, BNY CEO also, saying some supportive things. In fact, pretty much everybody, from members of Congress to former Federal Reserve chairs have said that what the administration is attempting to do is a bad idea. So I guess, George, what is the market pricing in as the probability that they're going to keep at this or go through with it? And how should we sort of be thinking about this? Was it a trial balloon? What was this?
Yeah, no, that's a really good point. I mean, if we look at the market, sort of started to price in the idea that Powell stays on longer than expected. And so there's some unintended consequences of, the maneuvering or the, sort of the challenges that the Fed faces. And as Powell mentioned, sort of it's not unprecedented for a Fed chair or the Fed in general to get pressure from either the administration or other politicians who would like to see easier policy. This seems to be extraordinary and much more intense than anything that we've seen in the past, but still, it's their job to basically stick to the mandate, which is follow the data, respond to the economic conditions, and set policy where they think, where they're able to try to help foster long-term growth in the broader U.S. economy. Now, there's a strong argument for independence, and unfortunately, the outcome is never immediate. And so right now, I think financial markets, bond market in particular, is taking a somewhat benign view. But we'll have to see. We'll have to see how much more pressure is ultimately implemented, and whether or not this is sort of high stakes poker or intense negotiations, if you will, rather than the actuality of being able to truly influence monetary policy. Powell put up a pretty good defense over the weekend. We suspect that he has the support of a large percentage of the board. And so policymakers, the Fed in particular, we think will stick to the mandate. The mandate is stable prices and full employment, based on the data that they're seeing from the economy. And we think that will be the ultimate principle. They're clearly under a lot of pressure to take policy easier, but there is structure within the Fed to prevent that from happening in the extreme.
Claudia, do you share that confidence that these attempts to sort of jawbone policy won't be successful?
I'm less optimistic over the longer run, right? This is the pressure campaign on the Fed has escalated over the past year. I don't think this latest salvo is going to be successful, and I think it could very well backfire. But I mean, Powell is towards the end of his tenure as chair. We have, a new chair will be announced soon, has to go through confirmation. I mean, this is going to be a pretty chaotic transition, and it's, there have been a lot of statements like Jamie Dimon's over some time now about why the Fed should be let to do its job, and yet the administration keeps coming back and applying more pressure. So I just am concerned that over time, the guardrails, there being a lot of pressure is being put on the structure of the Fed to kind of hold together. And, how long does that really last?
Guys, we got to put a pin in this conversation. George, going to say thanks to you. Jennifer and Claudia, you're going to stick around. And of course, I mentioned those comments from Jamie Dimon. So let's get more on that now. Shares of JPMorgan slightly higher pre-market after reporting earnings for the fourth quarter of 2025. The bank did take a $2.2 billion charge connected to its takeover of Apple's credit card business in the quarter, and it's not going to recognize the revenue from that for a while. Here were some of the biggest takeaways from CEO Jamie Dimon and the numbers is Yahoo Finance executive editor Brian Sozzi. Saz, what stands out to you in terms of what the company reported?
Hey, Julie. Well, I got three takeaways just getting off that reporter call for JPMorgan. Number one, the investment banking business for JPMorgan down 2% year over year. It wasn't a great quarter, and you heard CFO Jeremy Barnum. He went through at length on this call that I was on, explaining why that happened. He flat out said we were not impressed with this business, we didn't execute. So I would be curious on how the other investment banks, as they report this week, what those results look like. Is it a broader thing where deals are getting pushed out, or is JPMorgan losing market share? So something to watch there. Number two, the stocks part of that business, the equity trading part of the business for JPMorgan up 40%. Of course, Julie, that reflects the big gains we've seen in markets. So I would suspect if JPMorgan did good in this quarter, and it did, that will probably be a positive call out at other investment banks as they report over the next few days. And then, Julie, like you've been talking about all morning long, this Fed independence issue. I was on a call earlier this morning with BNY CEO Robin Vince. He noted any challenge to the Fed independence, not a good thing. Wouldn't it be good, likely for bond markets? Heard that same vibe over from Jamie Dimon, too, on the media call around 8 o'clock today as well, Julie. And then lastly, I would just add this, too, in terms of hot takes. CFO Jeremy Barnum over at JPMorgan talking about the potential credit card rate cap at 10% potential. He said it would be bad for business. No surprise there, I guess, Julie, to hear a credit card executive say if our rates are capped, it wouldn't be good for business. But he didn't want to quantify that impact.
Yes, I believe he said it would be very, very negative, was the quote that I saw him use on that front. So, and he also said that it wouldn't help consumers. So not only would it not help their profitability, he said it wouldn't be helpful to consumers either, which I thought was interesting.
Correct.
Yeah. Brian, thanks so much. I know you're going to be monitoring it. We'll all be monitoring the JPMorgan conference call as well. We'll be bringing you much more analysis of those earnings over the course of the morning. Coming up, more on the December CPI report as well. Stay tuned. Let's take a look at market reaction to the consumer price index that we just got. Jared Blickery has the details on that. What's moving, Jared?
Thank you, Julie. We're seeing stock futures moving slightly. They did spike up on the announcement. In fact, we got record highs in Dow futures along with the S&P and Russell 2000 futures. But as you can see here, we're looking at the Dow. That has sunk back into the red. We're only talking about 74 points or 15 basis points. So very small amounts here. S&P 500, I'm going to call this flat after spiking again to that record high. NASDAQ futures just up barely, and the Russell 2000 is still up about 1/3 of 1%, although pretty far off of those highs there. So let's take a look at the bond market. These are bond market futures, so these move opposite the yield, and so we're seeing 2-year note futures. Those are heading up. That means I think I saw after the report, we saw this down about 2-3 basis points, and we can also take a look at the 10-year tenor. That is also up, which means yields are down. And just taking a look at gold as well, we saw a tiny little bit of movement there. We can see that gold was in the red for most of the night, but that's after reaching record highs yesterday. Gold and silver both had a big days yesterday, so not surprising to see them take a little bit of a breather. Sometimes Bitcoin moves on these reports, sometimes it doesn't. And here we see a tiny little movement. Bitcoin in the green over the last 24 hours, but not a lot of movement off of the report. So let's take a look at the sector action. And this is what happened yesterday. Staples were leading up 1%. Financials were lagging. I'm going to put on the overnight quotes, and you can see those in those little rectangles here. Energy is the best off. That's up about 0.7 of 1% in the upper left, followed by industrials and then communication services. What's in the red right now, financials. Big bank earnings, we've been talking about those. Those are in the spotlight. We'll take a look at JPMorgan in a second here. Consumer discretionary materials and staples also in the red, but just very, very slightly. I'm going to first take a look at the NASDAQ 100, and here we see NVIDIA up about 0.4 of 1%, Alphabet up 1%. It looks like Tesla's up about 0.4 of 1%. Not a huge move there for any of the Mag 7, but let's take a look at those bank stocks and see what JPMorgan is doing. It is now just about flat, down 1 basis point, and you can see it just turning green there. Bank of America kind of oscillating around the flat line, and it looks like Citigroup also down about 3 basis points. Send it back to you, Julie.
Thank you very much, Jared. Appreciate it. Well, President Trump is pushing an agenda focused on affordability, unveiling several proposals since the start of the year that are aimed at addressing rising costs. The proposals including a 10% cap on credit card rates, a ban on large investors buying single-family homes, and an order for government-backed mortgage finance companies Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage bonds. The president most recently also focusing on the cost of electricity, saying that Microsoft will be making changes to ensure Americans don't pay higher utility bills for power consumption from the AI data center build-out. Still with me to talk about these affordability issues, Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director, and Claudia Sahm, New Century Advisors Chief Economist and former Federal Reserve Board Economist. And I believe also Microsoft is out with some of its plans over the build-out of its data centers. But I'm curious, Jen, as you look at these various measures, proposals that the president has talked about, how far do you think they go at sort of solving or helping solve some of these affordability issues?
Oh, that's a tough question. Oh boy, the reaction, of course, I'm sure all these CEOs were very, polite in their answers and said, yes, we will try, and I'm sure there will be an effort to comply. But there's only so much that these corporations can do. I mean, people have to make money, right? The companies have to make have to boost earnings or make earnings, and if they're swallowing all the costs, they already did it for some of the tariffs, and if now they're being asked to do so in terms of their electricity usage and all that. It's going to be tough. So, at first glance, obviously, it suggests that we will see some lower pressures, I guess, on inflation. But again, as Claudia was mentioning earlier, longer term, I don't know how much lasting power this is going to have. And I think that's the big question, is that whether or not they can actually afford to be able to do so going forward in the longer term.
I mean, by the same token, Claudia, if you look at the estimates for corporate profits this year, they're expected to still go up, and particularly for the tech firms. So I guess there's the question of, can they afford it? And there's also the question of whether how much and whether this will move the needle.
Right. Yeah. So, affordability is a real issue. I mean, and it's not just like a political slogan. It is affecting people's lives, and prices have gone up. And so efforts to make the basics more affordable make a lot of sense. What I worry about is, we're starting a midterm election year. It's clear the president is very focused on re-election. I mean, politicians, that's what they do, right? Like this, it makes sense that we're seeing this. I am concerned about this continued flood the zone approach to economic policy, right? You put out all of these different ideas, and in particular things like announcing a 1-year 10% cap on credit card rates, just kind of out of the blue, and kind of pushing like this is going to happen by next week. I think that's not how economic policy gets done. So we're in, like, this is, if you had a good policy and you pushed it through and it actually meant something to people in the end, that would be great. But this has a lot of, there's a lot of spectacle to this, and I'm really concerned about whether this ends up meaning anything to people.
Claudia, what would be a more holistic approach to all of this, just briefly?
Well, I think one thing that concerns me, like with the credit card cap, which, even if one thought that were good economic policy, and there have been proposals put out from different senators and whatever, I'm not in favor of a cap, but you wouldn't propose it for 1 year, right? Like that is such a political move for 1 year, because that could actually get people in an even worse position if they took on more debt because rates were lower. So I guess just really backing up, slowing down the process, focusing on like really moving the needle, which is going to take time. It's going to take more time than the clock has left for the midterms, frankly.
Yes, well, the vagaries of politics make certain this is our system. I guess, Jennifer and Claudia, we're going to leave it there for now. I'm sure we'll continue the conversation next time. Thank you.
Thanks.
Stay tuned. Morning Brief is coming your way next. We've got more coverage on the CPI report, on JPMorgan earnings, and as well as Delta numbers. We'll be right back. Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, inflation showing signs of easing. Core December CPI coming in slightly better than economists estimated. Markets little changed after the Dow and S&P 500 closed at new highs on Monday. And JPMorgan shares were also little changed ahead of the opening bell on Wall Street. The bank posting better than expected results for the fourth quarter, although investment banking revenue missed estimates. CEO Jamie Dimon saying the economy is resilient and business remains healthy despite weak consumer sentiment. He also spoke out on the independence of the Fed, saying any moves to chip away at that is, quote, not a great idea. Meantime, 20% earnings growth not enough for Delta investors. Shares of the airline are sliding after its full-year guidance underwhelmed Wall Street. The company says it sees strong demand for consumer and business travel, and people are paying up for premium. The airline's fourth quarter results came in stronger than expected. Let's get a check-in on stock futures right now. Now, initially, after we got this morning's consumer price index data, and it came in a little bit better than estimated on the core, excluding food and energy, we saw a little bit of a leg higher in futures here. But since then, they've settled out. Now we're seeing a mixed picture. Investors also, of course, considering the likes of JPMorgan and what we might hear from the rest of the banks throughout the course of the week and throughout earnings season as well. So for now, Dow futures are off about 29 points, S&P and NASDAQ futures indicating a very slightly higher open. And indeed, stocks a little changed after the December CPI report came in slightly cooler than expected. Joining me now to discuss, Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer, and our Federal Reserve correspondent, Jennifer Schonberger. Jen, I'm going to start with you here. And what stood out to you from the CPI report, especially given the sort of wonky end of 2025 that we had in terms of data collection?
Yeah, absolutely, Julie. I mean, core CPI coming in a little bit lighter than expected, 2.6, but you know what? That was holding the same level of September through November. So that shows it's still a bit sticky there for the last 4 months of 2025. And so I don't think the Fed really moves on this or changes course for the end of this month. That is, I expect them to take a breather from rate cuts and hold steady. But like you said, the data's been a bit wonky, and we should probably take this print with a little bit of a grain of salt because the data is likely skewed from the past collections that we saw for October, or lack thereof, I should say, and then November. The BLS seemingly had to back into some of the calculations, particularly for shelter, and seemingly penciled in 0 for shelter, which is why we saw such an increase of 0.4%, which really contributed to the upward pressure here. So I wonder how much of this is skewed. I think we're going to have to see a couple more year-over-year readings before we start to get a clean take on this. Perhaps this number coming in a little bit higher than what it could have been.
Jeremy, what's your take on the numbers? How sort of seriously or literally or whatever you want to call it are you taking CPI?
Well, it's great to be on with you both. I actually have been following this trend on shelter for a long time, and we actually think there's a lot of issues in the calculation of shelter, not just in the last month. We put out our own measure of inflation using more real-time measures of shelter. You know, the official BLS number year over year is 3.2. When I look at things like apartment list, has negative. It's declining. And I look at Zillow, it sort of average the two together. I have a 0.5 on shelter. And when I plug that in to just basically doing that simple substitution to CPI, I get core CPI at 1.6 and headline at 1.85. So shelter's had a lot of issues for a while. This was one of the things we saw shelter spiking in 21 when the Fed was saying it was a transitory, real inflation was much higher. Now it's actually much lower. And so this should be comforting for the Fed if they start looking at sort of these alternative measures of shelter.
Do you think they will? Do you think they are, Jeremy?
There's commentary. We were alone talking about this for a while. You see a lot of it talking about it. And so I do think this is part of the thing that's offering the trend. I'd say the trend's their friend. It's going to come down officially over the next 12 months.
And Jen, it doesn't seem to change what's going to happen at the January meeting, especially given the sort of political cloud around the Fed right now. But what have you heard from Fed officials in terms of the alternative data or how they're reading shelter?
Well, to Jeremy's point, we heard from New York Fed President John Williams, and he does expect inflation to come down in the second half of the year. He's quite bullish, actually, on the outlook for the economy this year. He thinks inflation is going to peak in the first half of this year before it starts coming back down, and will end the year just below 2.5%, which is pretty reassuring, though he seemed to indicate that the Fed is okay to hold right here, right now, because he said that rates are well positioned to bring down inflation while also supporting the labor market. And so he seemed to indicate, look, we did 3 rate cuts at the end of last year. We took out that insurance, and we're well positioned to sort of sit here and look around. So it looks like, to Jeremy's point, they do expect to see inflation start to come down. Those one-off impacts from the tariffs start to come out of the data. And they think if you account for those tariffs and you take those out, inflation's still on its downward trajectory.
Of course, all of this comes amidst the backdrop of Jay Powell sort of opening a new front, as it were, in the sort of conflict with the administration. And Jeremy, this morning, both JPMorgan CEO Jamie Dimon, as well as BNY Mellon CEO Robin Vince, on their conference calls or on calls with media, sort of lending support to the idea of Fed independence. Does that surprise you? I mean, they've been sort of apolitical, many of the CEOs. What does it tell you that they're speaking out on this?
Well, there's no guarantee the Fed can be independent. The Fed is a creature of Congress. So like one of the things we were saying, our senior economist, Jeremy Siegel, was saying earlier, and people were raising their eyebrows, that Powell should have resigned and put it all on Trump and said, he was actually in some ways compromising the Fed independence by staying where he was. So there's, different takes on that question. But I think the trajectory is on the right path. They're not far from neutral. We think they should be 2 to 3 cuts below where they are. But you're getting a more normal yield curve shape. For a while, we had a very inverted yield curve where the Fed funds was higher than the 10-year. You're now, 50, 60 basis points positively sloped. It should be like 100, which is why I say 2 more cuts would be probably appropriate. But you're getting close to neutral. And, so they're on the right path. And, we'd like them to be there sooner. But, they're not far from being neutral.
Jeremy, let's get to stock strategy here for a second, or multi-asset strategy as well. So you've got what's going on with the economy and the Fed. You've got what's going on geopolitically, also increasingly, between Venezuela and Iran, et cetera. Are you tweaking strategy at all, given some of the backdrop here?
It's an interesting, you've had basically 2 themes, AI and U.S. tech leadership dominating all the global markets for the last 15 years. Last year, it was sort of this beginning of the year, you questioned U.S. exceptions. We started seeing international start to outperform. You haven't seen really the broadening, the smaller caps take leadership from large caps. As you go through earnings season, one of the things we're watching is, will the AI benefits everybody? And I think the consumers of the technology are going to start to see margin improvement. You're seeing it with the Fed lowering rates. It's helpful for borrowers, sort of small cap companies, and the valuations are much more supportive there. And so I think that's the key thing we're watching. We do think there's this rotation coming, but also international has been ignored for a while, and there's still a lot of very, very good valuations outside the US. And, I think that is, we call it the defense tech super cycle. All the spending on defense in Europe, in Asia defense is probably one of our top themes looking ahead. But that spending is going to lead to a lot of innovation. And we think we'll get a lot of new technologies out of international. And so I think people have been underallocated there.
And I know that you guys like Japan in particular.
So Japan, the Takaichi trades have been very, very hot. Even overnight recently, you saw more sentiment, bullish sentiment coming to Japan. It's been one of our favorite markets for a long time. Our Japan Opportunities Fund, OPPJ, has a 12 PE. It has all the Buffett stocks that he's been buying. The top 5 holdings in those names are almost 40%, 45% of the fund. But 12 PE, when the S&P is 24 PE, is a very attractive number. And these companies are growing and doing a lot of good things with increasing dividends and buybacks. So that's one of our top ideas when you go overseas.
We're seeing some yen action, I know, overnight. The yen sinking. How does that inform the trade that you're talking about?
Yeah, the currency is one thing people get wrong all the time. We've been suggesting you should be thoughtful about how you manage currency risk. Most people, when they buy Japan, they just buy the yen. And if you did that, you were, significantly last decade, your returns were something like 7% versus 14% a year for the last 10, 12 years. So people bet wrong on the yen. At 160, it's getting, it's not a cheap, undervalued currency, but things can be surprising when you go to the currency market. So we try to have a thoughtful approach on how do we hedge that risk. You're still getting paid to hedge that risk. And, we are, more hedged than we're not in that Japan Opportunities Fund.
Jeremy, good to see you. Thank you. And our Jennifer Schonberger, as always, tracking the economic data and the Fed. Appreciate it.
Thanks, Julie.
Coming up on Morning Brief, we'll bring you today's top trending tickers and a deeper dive into Delta Airlines earnings. We'll be right back. Now time for some of today's trending tickers. We are watching JPMorgan Chase, L3 Harris, and oil. First up is JPMorgan Chase. The bank's overall results beat estimates, but looking under the hood, there were some signs of weakness. Investment banking revenue declined, and the company also taking a charge tied to future losses for taking over the Apple credit card business. And when it comes to President Trump's proposal to cap credit card rates at 10%, JPMorgan CFO said it would be, quote, very bad for consumers and very bad for the economy. The shares are little changed at the moment. And next up, we've got L3 Harris here. The shares of the defense contractor are soaring ahead of the open. The company is securing a $1 billion investment from the U.S. government. It also announced plans to spin off its missile business into a separate publicly traded company. It expects that IPO to happen in the second half of this year. And by the way, it closed at a record yesterday, so that gains today means another record for the stock. And finally, oil prices, crude trading above $60 a barrel amid rising geopolitical tensions. Concerns are rising that Iran's supply could come offline amid the demonstrations rocking the country, as well as President Trump's new tariff threat. In a Truth Social post, the president said the U.S. will hit any countries who do business with Iran with a 25% tariff, and Iran exports most of its oil to China. Well, shares of Delta Airlines are under pressure after the company delivered earnings for the holiday quarter that topped expectations, but shared a more conservative outlook than expected. The airline's premium segment did perform well in the fourth quarter, with CEO Ed Bastian saying the airline's premium consumer, quote, happens to sit right at the top end of the K-shaped economy. For more on Delta, Nicholas Owens, Morningstar equity analyst, is joining me now. Nicholas, so when you look at these numbers, the backward numbers looking pretty good. The forecast, maybe the midpoint of the profit forecast, not quite where the investment community wanted it to be. What do you think here? How are you weighing those?
Thanks for having me, Julie. Well, I'd start with, I'll just give as context, my fair value for Delta Airlines is $32. So this has been the most overvalued name on my list for a while. I would even say that 25, they delivered 33% earnings growth, but all of that came from gains on investments. So, and it's been a great part of their story that they have premium customers. That's well known, but more than half their passenger revenue still comes from the cheap seats, and those declined in the year. So I think, they're promising 20% earnings growth in 2026, and that's great. But I just would say this isn't a perpetual motion machine, nor should you expect it to be in a relatively mature travel market.
I mean, and the other thing that seems to be a little bit of a disappointment was the estimate for free cash flow. The company said it's going to be $3 to $4 billion, which would be a decline from free cash flow last year. So to you, is it primarily a demand situation? Or is it a cost situation, or both? And kind of what are those pressures on the cost side of the equation?
Well, all the airlines really do face, let's say, perennial cost pressure. And another way the way I've been thinking about the industry for the last, say, year or two is it's kind of back to normal. So you have this incredible rebound post-COVID and very, very impressive growth rates and impressive revenue. They're making more revenue per seat than they used to. Largely driven by this sort of premium customer and people willing to pay up for travel experiences. But again, that kind of has to level off here somewhere, and I think that's what we're seeing. You can't do 33% growth forever, so to speak. And the cost pressure, they got some relief because fuel was cheaper last year, and I thought they did a good job. I mean, their non-fuel costs were only up, unit costs only up about 2%, so that's pretty respectable in terms of discipline there.
The company, speaking of costs, the company is also putting in an order for Dreamliners, its first ever, 30 Boeing Dreamliners. What does this tell you, if anything, about kind of the company's confidence in the future or where it's going?
It's an interesting item. So United had placed a very big order for Dreamliners, and it's a great plane. It's performing well for airlines, and people like to fly in it. So I think they're interested in putting the best product out there. The fact that it's a new model to them, I don't think is particularly meaningful. It fits the best plane that for the job.
And when you're looking at Delta, which obviously you see as a little bit expensive here, that said, most of the time it's sort of viewed as one of the best in class within the airlines. So are there others you like better? Does it kind of, it's doing better than the rest? And so,
Right.
How are you kind of contextualizing it?
I guess the way I view it, so best in class in a rowdy class. Airlines are not a great business in general. I mean, again, they've been doing well, and largely on the back of this kind of appetite for premium travel. But if it isn't air traffic control or weather or something, there's sort of always something. It's not an easygoing business. It's a tough business. And these billions of dollars of cash flow are very impressive, and 10% operating margin. But if you fast forward to sort of a more slow economy, or maybe potentially a recession someday in the next couple of years, and that back half of the cabinet softens up even more, those numbers could shrink really quickly. Small changes in an airline's operations can make big changes to their bottom line.
And Nicholas, I thought it was interesting, and again, this is something that could affect other airlines as well. I thought it was interesting the company talking a little bit about international travel and saying that some of the geopolitical tensions could potentially weigh there. How much of a factor, well, in the past, how much of a factor has that been, and how much of a factor do you think it could be this year?
We have been I cover defense also, so geopolitics has been on the tensions, let's say, have been on the rise for 4 or 5 years, and so there could be more of these episodes where you have air traffic, banned to a certain region for a couple of weeks or months, or you name it. I wouldn't rule those possibilities out. In general, though, for a while, airlines stopped flying to Tel Aviv, et cetera, for a short time a couple of years ago. It doesn't really usually add up to that disastrous a number, and they can work around it usually. But it's always in the wings, let's say, as a potential source of disruption, or something that's going to alter the forecast here and there.
Nicholas, thanks so much. Appreciate it.
Thanks for having me.
Coming up on Yahoo Finance Opening Bid, our executive editor, Brian Sozzi, is joining us now. Soz, I know you've been sort of pouring through some of the bank earnings this morning. You've been on calls. What can we expect?
Julie, it's been a busy morning, but you know what? This is what we show up for. This is what we do, Julie. It is the start of earnings season, and to your point, I think big bank executives, and you were talking a lot about this right after the numbers, Julie. Big bank executives like JPMorgan CEO Jamie Dimon, BNY CEO Robin Vince, are sending messages to the Trump administration saying, hey, you better ease back on those attacks against Fed Chair Jerome Powell. It could impact the bond market. It could impact efforts to bring down prices in this country. So there's that. But also opening bid, Julie, also going to talk about some stock ideas. I don't want investors to lose focus that there are still stocks out there to buy. I know they're all captivated by this Fed news, but you can still go out there and buy stocks.
All right. I look forward to those ideas.
I know you do.
That does it for Morning Brief. We got Opening Bid next on Yahoo Finance.